As you've been following along in this series, we've established what financial wellness means and covered the basics of creating a spending plan. Now let's find out what you can do with your daily spending habits to help better your credit and credit scores. Credit scores range from 300 to 850 points, with an average score being about 650. Having a higher credit score means you've reliably managed your debt. Your credit score is not directly affected by how long you've lived in one place, your occupation, your income, your age, or even if you participated in credit counseling. Paying household bills on a normal basis doesn't affect your score. Neither does running your own credit report. In fact, running your own credit report is highly encouraged for several reasons. You want to know what's being reported about you. When you run that report, you have the opportunity to challenge negative or inaccurate items on that report. Challenging that item gives the creditor 30 days to respond with proof, or the inaccurate activity is removed from your account. You can run these reports for free at any time of the year, one time per year per credit bureau at annualcreditreport.com. Remember to obtain reports from all three credit bureaus, Equifax, Experian, and TransUnion. What might be reported to one may not be reported to the remaining two. Now that we have a basic understanding of credit reporting, let's look at what makes up your credit score. There are 5 parts to your score, and each one is weighted differently. Payment history is the largest factor in your score and worth 35%. Have you ever wondered just how much one late payment could affect you? I'm here to tell you it matters a lot. A late payment could negatively affect your score anywhere from 20 to 50 points. Now keep in mind that late payments are anything over 30 days. If you have a due date on the 1st, but you pay on the 7th, chances are you'll receive a late fee penalty from the credit card company, but it won't affect your overall score. What if you're trying to rebuild or establish your credit, and you're very successful at paying bills like utilities, cell phone, insurance premiums on time? Payments to vendors like these won't help you rebuild your credit. If one of those accounts goes into a collection agency, it will be reported to the bureaus. I can't encourage you enough to avoid late payments whenever possible. Debt to credit ratio is very important to understand, since it comprises 30% of your score. Simply put, this section looks at how much your available credit is in use. Now let's say you have 2 cards that each have $5,000 in available credit. Card A has a balance of $2,500 and Card B has a 0 balance. Now this means that your debt to credit ratio is 25% since you're only using $2,500 out of an available $10,000 balance. This is ideal because you only want to carry a balance forward of no more than 25% of your available credit to help maximize your score on this section. If you max out your cards each month and carry that balance forward, it can be viewed negatively and you may lose points on your total score. If you're a savvy consumer who wants to enjoy all the rewards, airline miles, and cashback bonuses, by all means use those cards wisely. The trick is to either pay off the card each month and keep the forward balance at or below 25% of your available credit. If you look at your credit report under each credit card, you'll see the high balance reported. This indicates what you've carried forward each month as an outstanding debt. Keep that in mind as you collect those rewards benefits from the credit card. The next factor in your credit score is length of credit history, which is worth 15%. This looks at 2 things, the age of your oldest account and the average ages of all your accounts. Occasionally, this section will intertwine with debt to credit ratio. So let's go back to our previous example with Card A and Card B. Card B, as you remember, holds a 0 balance. This card happens to be your oldest line of credit, which you've had since college. Of course, you've worked hard to keep balances reasonable and have always paid on time. But maybe you're thinking that you want to cancel the card because the rewards program isn't very well rewarding. Consider this. If you cancel Card B, your debt to credit ratio jumps from 25% to 50%, and you lower the average age of all your accounts by closing out that oldest relationship. Canceling old cards isn't always bad, but be sure to look at what your debt to credit ratio is and if that card is or one of your oldest lines of credit. Another important aspect of your credit score is new credit, which is valued at 10% of your score. There is one simple rule to new credit. If you don't need it, don't open it. Opening several lines of credit in hopes of establishing or rebuilding your credit is viewed as high-risk behavior by the credit bureaus. Not to mention it also lowers the average age of all your accounts. Avoid this when possible. You may be approved to open these lines of credit, but you might get saddled with higher interest rates, lesser terms, and possibly lose points on your total credit score for having too many hard inquiries. Hard inquiries are when you apply for a new line of credit and can dock your score a couple of points if you have several in a short amount of time. Soft inquiries are things like your pre-approved credit card offers or running your own credit report. Those aren't going to affect your score. There are two exceptions to this new credit rule: buying a home and buying a car. For a mortgage, you have a 30-day window to have as many lenders do a hard inquiry on your report so you can shop for the best terms of a loan. Buying a car has the same provision, but with a smaller 14-day window. Types of credit is the last component of your score, and it's also worth 10%. This section will list all of the lines of credit that are associated with you. Your credit cards, car payments, student loans, and mortgages can all be found under here. How do your daily spending habits affect your credit and credit score? Paying late directly affects your payment history, which is the largest aspect of your score. Keeping low balances reflects positively on your debt-to-credit ratio. Canceling old cards may not be the best choice because of how it can affect your length of credit history, which is the third largest component of your score. Remember the rule with new credit: if you don't need it, don't open it. Lastly, know that it's important and useful to run your credit reports each and every year. You get an annual medical checkup to make sure you are healthy. Do yourself a favor and get a financial checkup once a year as well. Up next, we're going to take a look at how to get the most out of your employee benefits and tips on how to plan ahead for the future.